Okay, let's dive right into this explainer. If you're in the loop on industrial battery applications, you already know that LFP, lithium iron phosphate, has basically become the absolute default choice for project developers around the world. But today, we're going to explore a massive risk hiding just beneath the surface of that trend. We're going to break down the critical commercial and technical disparities within LFP battery chemistries. Specifically, we'll be looking at the very real gap between established Tier 1 manufacturing standards and the cheaper, fast-follower cells that are flooding the market right now.
Because right now, there's this really dangerous tendency in asset management to treat all LFP cells like they're identical commodities. You need a cell, you buy a cell, right? Well, wrong. Treating all lithium iron phosphate cells as equal is a costly illusion. We are going to totally dismantle that illusion today so you can see exactly why assuming equality across manufacturers is putting massive battery energy storage system or BESS projects at severe operational and financial risk.
So let's jump straight into Section 1, the costly LFP illusion. Let's unpack this and figure out exactly why independent energy asset managers are falling into this trap in the first place.
It usually starts in the boardroom. On paper, when you're comparing options, the datasheets for a Tier 1 battery and a fast follower battery look pretty much identical. They promise the exact same capacity, the same efficiencies, all the baseline specs match up perfectly. But when you move from the paper to real-world stress, when you actually deploy these multi-million-dollar assets into the field, massive gaps in degradation and cycle life suddenly show up. Established Tier 1 manufacturers and fast followers absolutely do not perform the same once the system is pushed.
Which brings us to Section 2, Tier 1 versus fast followers. Let's break down the exact differences between these two tiers.
The hidden operational risks become glaringly obvious when you look at them head-to-head. First up, think about capacity fade. Tier 1 cells tend to follow a really predictable, gradual degradation curve. But fast followers, they often hit this sharp, accelerated capacity fade under the exact same conditions. Plus, Tier 1 cells are engineered for true cycle life resilience over thousands of cycles, something fast followers just can't match. Because they lack that manufacturing pedigree, they introduce a massive wave of hidden operational risks into your energy storage system. You're literally rolling the dice on the core component of your infrastructure.
So why does this actually happen? Well, it all boils down to cell inconsistency. This means you've got manufacturing quality variations that accelerate capacity fade way before the projected lifespan. You see, fast follower manufacturers usually lack the hyper-strict quality control of the Tier 1 producers. When you pack thousands of these slightly inconsistent cells into a utility-scale environment, they don't share the load evenly. Actually, scratch that. It's more like a tug-of-war, where the weaker cells literally drag down the stronger ones. This exact mechanism of cell inconsistency is what causes fast follower batteries to fail prematurely. It makes those identical datasheets completely meaningless in the real world.
Moving on to Section 3, the hidden CapEx trap. Now that we get the technical flaws, let's explore the massive financial consequences for utility-scale operators.
Look, it is incredibly tempting for a procurement team to look at a fast follower cell, see a much lower upfront price tag, and just celebrate those capital expenditure savings. But those initial CapEx savings, they vanish quickly. It's a complete trap. Because of the accelerated capacity fade and cell inconsistency we just talked about, whatever money you thought you saved up front just evaporates. When cells degrade long before they're supposed to, you're forced into early replacements, way more maintenance, and crippling system downtime. Your initial CapEx savings get completely wiped out by skyrocketing operational costs and lost revenue generation.
All right, Section 4, 3 due diligence criteria. To protect your long-term yield models from this trap, we need actionable solutions.
These are the 3 critical, non-negotiable due diligence criteria that procurement teams absolutely have to apply. Step 1, look beyond the spec sheet. We know data sheets are an illusion, so you've got to dig deeper. Step 2, evaluate cell-level manufacturing quality. You have to understand the actual quality control happening on the factory floor so you don't buy into cell inconsistency. And step 3, assess true operational pedigree. Do these cells have a proven track record in real-world large-scale BSS environments, or are they just relying on lab-tested theories? Applying these 3 criteria is literally the only way to avoid the CapEx trap and ensure the long-term viability of your assets.
To wrap up this explainer, I want to leave you with this pivotal question to ask yourself. How are your systems holding up in the field? Have cell degradation or performance deviations already started to subtly eat away at your long-term yield models, or are you truly seeing stable, predictable operations? Because in the high-stakes world of industrial energy storage,
treating every LFP cell as equal is a luxury no asset manager can afford.